Hello everyone, welcome back to the channel. Today I will do an overview of what happened last week with all the IPOs, Tesla, Disney, NIO, Uber and more. If you're new to my channel, consider subscribing and smashing that like button since it really helps the channel out. Also remember, I have a completely free Discord group chat, which the link for that is down in the description below. What a strange week. The S&P 500 ended down by 0.84%, the Dow Jones down 0.66%, and the Nasdaq ended slightly on the green by 0.18%. This mostly happened because of the outlook of additional stimulus since it is still very uncertain. Both the S&P 500 and the Dow Jones posted the first red week in 3 weeks. Optimism surrounding a near-term fiscal stimulus deal are fading despite reports of a bipartisan deal, as the sides can agree on the size of the deal but not on details. Obviously, without another package, we might see people lose their unemployment benefits, and I think it is very important to make a quick decision, as some states like New York are starting to close indoor dining again as hospitalization and cases have increased. I would suppose that with time they might close more things and we might see the same thing happening in other states. Now, we had two major IPOs this week. We had DoorDash on the 9th and then Airbnb on the 10th. First, DoorDash. DoorDash was supposed to go live with a share price of $102 per share, and it ended up opening at $168 per share and went as high as $190 per share. That is an 85% return in the very first day for anyone that was able to buy at $102 per share, which is insane, since it meant that it had a valuation of over 50 to even $60 billion for a company that has reported a revenue of $1.9 billion as of September 30th, 2020. Then Airbnb. It was supposed to go public with a share price of $68 per share, which I knew it was going to be impossible to invest in those prices, and set buying orders at $70, $80, and even $100. Even knowing that I would be paying a huge premium for it. And boy, was I wrong. The stock went live with a share price of $146 per share and got as high as $152, which was a valuation of about $95 billion. And it has been dropping since then. Obviously, I did not invest in any of these IPOs since that was insane and wouldn't make sense at all with DoorDash nor Airbnb, since Airbnb has a revenue of $4 billion in revenue. It went up over 120% during the first day as a public company. Would like to know what you guys did about this. Did you invest in any of these two IPOs, or what prices are you targeting? Let me know in the comment section below. Talking about IPOs, I posted a video analyzing Roblox IPO, which was supposed to go public this month, December 2020, but they have decided to delay their IPO until next year. Roblox is a video game company that operates a free online platform that has millions of games created by their own developers within the platform. They decided to delay the IPO mostly because of the gravity-defying performance this week of Airbnb and DoorDash, since that made it too difficult to determine the right price for the video game company shares. If you're interested in this company, I would really recommend you go and watch my video analyzing it. This is a company that is in an industry, the gaming industry, that in my opinion might see an uptrend in the coming months, as huge hedge funds are starting to invest money into it. The 2021 outlook for the booming SPAC market and the traditional IPOs. This year, 2020, we had a huge amount of companies going public through an IPO or initial public offering, or through a merger with a SPAC company. To be exact, there were 194 traditional IPO deals that raised $67 billion, the best year since 2014, according to Renaissance Capital. But it was an even better year for SPACs, which raised us about the same amount. Analysts are expecting to see plenty of big name unicorns companies that will go public with a traditional IPO in 2021, such as SpaceX, Stripe, Waymo, Instacart, and more. Which obviously, if that happens, I will cover all that in my channel. Now, you guys know I'm a Disney shareholder. The stock has performed pretty nice since it went up over 100% since March, and just on Friday it went up over 13% because of everything they announced last week. Plus the announcements that Disney Plus has over 86 million subscribers since launching over 1 year ago. Hulu has reached 38.8 million subscribers, and ESPN Plus has amazed 11.5 million subscribers as well. Take into consideration that Disney was estimating Disney Plus to reach 60 to 90 million subscribers by 2024, and just 1 year since launching, it has almost 90 million subscribers. Obviously, this is incredible since it took Netflix years to achieve this milestone, but we have to understand that we are in different eras. We do have to take into consideration that the pandemic helped accelerate the growth, but still, it is excellent that Disney has decided to focus on growing their streaming services while we are still in a pandemic. Disney represents 3.55% of my portfolio. I have an average cost of $123.20, which means that I have a return of 42%. Now, we all have seen how Tesla has performed this year. It is up over 608% year to date, as they have finally become a profitable company and are going to be included in S&P 500 on December 21st, 2020. And obviously, Tesla is going to take advantage of this uptrend. They are planning to sell up to $5 billion in stock just 2 weeks before it is set to join the S&P 500. It would be Tesla's second share issue since September. In my opinion, this is an excellent decision, even though they have a huge amount of cash in the balance sheet and they don't need more cash at the moment. It is not a secret that the stock is high and the EV company will always need more and more cash to invest in the company, innovate, and grow even more. And what better and easy way to do that than take advantage of the rise of their own stock. Also, Elon Musk had decided to leave California and move to Texas. Obviously, he is taking advantage of the situation, the creation of their new gigafactory in Texas, and that will obviously bring personal benefits for him, since Texas is a state that does not collect state income or capital gains taxes for individuals, and even more since he now qualifies for billions of dollars in stock options compensations this year, which make him the second richest person in the world. Talking about EV companies, NIO provided their November delivery updates and more. During November, they delivered 5,291 vehicles, increasing 109.3% year over year. It reached over 36,000 deliveries this year, which have been having an excellent growth. They also announced a proposed offering of 60 million American Depository shares. The company plans to use the net proceeds for research and development of new products and next generation autonomous driving technologies and sales and service network expansion. As I said before, with Tesla, and a company within the EV industry requires a lot of money for research since it is such a new technology, and to be able to continue innovating and improving their vehicle. Then, Uber decided to stop their self-driving cars and sell them to autonomous driving startups. They sold their self-driving cars to a Silicon Valley startup company called Aurora Innovations, but they will still have an exposure to the self-driving industry, since the two companies on Monday said that as part of the deal for the self-driving car unit known as Advanced Technology Group, Uber will make a $400 million cash investment in Aurora, holding roughly 26% stake in Aurora on completion of the deal. It is not a secret that this ride-sharing company have been doing everything that they can to be able to achieve their profitability goal next year. And one of the things that they have done is to get rid or scale back their expensive businesses, as they did with their electric bikes and flying cars, and would assume that the self-driving cars was taking a lot of money and time in research that was not helping in the profitability goal, so they decided to sell the project to a startup company. Now, Costco reported earnings this past week. They reported an increase in sales of 17% for USA, 16.8% in Canada, and 17.7% internationally. And obviously a massive growth of over 86% in their e-commerce segment. They reported a total revenue of $43.2 billion, which is a nice growth of 60% 6% year over year. $42.3 billion came from their net sales and $861 million from their membership business. Their merchandise cost represents 88% of the revenue, which is good but not the best, and reported a net income of $1.16 billion. Still, in my opinion, Costco business model is more about the volume of people that buy in their stores than the margins that they could get from the products, since they tend to sell everything really cheap with a small margin to be able to attract more clients. They have over $13.5 billion in cash and cash equivalents and total assets of $60.2 billion, which has highly increased since August 2020. Have total liabilities of $44.9 billion, which have also increased. In my opinion, Costco has had an excellent quarter and was able to beat analyst expectations. Chewy also reported earnings. They reported an excellent revenue growth of 45% year over year. Obviously, the pandemic has accelerated the growth since pet adoption increased a lot during lockdown, and obviously e-commerce of pets have increased. The stock has increased over 187% year to date, which is massive. Now, next week we might see more about Pfizer vaccine and possible stimulus package. Also have some nice companies such as Lennar, ABM, FedEx, AAR, and more reporting earnings. Thank you everyone for watching. Hope you enjoyed the video. Please smash that like button and subscribe, since it really helps the channel out. Also, remember about the 4 free stocks you can get with Webull by opening an account with them and depositing $100. Thank you and see you next time.